And particularly with the foreign markets, because that's how we're invested. And normally, I've been coming to these money shows, and we're talking about how our accounts are doing really well, the stocks are going up, the dollar's going down. And so for the past 7 or 8 years, my clients, at least when they looked at their statements, it seemed like everything that we're doing was the right thing. Now recently, if you look at your statement, you might second guess the strategy. Our stocks have just gotten clobbered in the last month or two. And it's not just our stocks. It's not like you think, oh my God, Schiff got me in all the wrong stocks. It didn't matter which stocks I bought you; they're all way down. This is the biggest bear market, and it's happened in a very short period of time. I think that's me. Yeah, I gotta turn this off. Okay. This is the biggest global bear market I think I've ever seen. The emerging markets are down the most. Of course, they went up the most, but you got major markets like China and India down better than 50% this year. 50%. Every major market in Asia and Europe is down over 20%. Over 20%. So if your account is down 20 to 30%, that's just what's happened. And the dollar's actually gone up. The dollar, if you look at the New Zealand dollar, is at a multi-year low. We don't have a lot of Russian rubles, but I'm just listening on the news, it hit a 3-year low yesterday. And a lot of other currencies, the Singapore dollar just got clobbered. The yen is at a low. The euro is not really down on the year, but it's down. It was 160 less than a month ago. It's under 150 right now. So when you take into consideration that these foreign markets around the world are all down 20 to 30%, that's in local currency. So if their currencies are down, then from a dollar perspective, the decline is even more. So, if you're looking at your accounts and you're seeing it down 10 or 15%, you're actually doing really well. If you're down 20 to 30%, that's about what the markets have done. Now, there's a handful of stocks that we've recommended that are down 60, 70, 80%. Fortunately, that's not the majority. Let's say out of the maybe 60 or 70 stocks we recommend, maybe half a dozen have had that kind of performance from their peak prices. Now, of course, we still have stocks that have made 52-week highs. I think 3 or 4 of the stocks that we buy hit 52-week highs on Friday. So some of the stocks are bucking the trend, and some of the stocks have just gotten clobbered. The ones that have really gotten hit the hardest have been the resource stocks. Right? And so some people might have a portfolio that's more concentrated in those stocks because that's what they wanted. A lot of people come to me and they say, I want resources, I want metals, I want mining. In fact, the gold stocks, I own most of my account, about half my account is in gold stocks. I don't think there's a gold stock I own that's dropped less than 30% in the last month. 30%. Many of the stocks I own in South Africa are at 4-year lows. Gold's still about $850 an ounce, and they crush these stocks. Crush them. And if you look at the juniors, I'm talking about, I own a lot of the big cap stocks, the major stocks. Actually, the one that's helped us the best has been Newmont. But the ones that were the high flyers, Gold Corp was at a 52-week high a month ago. The stock was up in the 50s. It's $30. Now, same thing with Barrick. Some really big stocks that had been the leaders, like an Agnico Eagle. Stocks that were making new highs regularly have been crushed. Now, a lot of people are saying, I get some emails and they say, well, why is this going on? Why aren't you doing anything? Why aren't you stopping these losses? Well, we're not trying to stop the losses. And in fact, they don't even bother me. Probably on paper, in the last month, no one has lost more than me. And it doesn't bother me at all. I don't care. Because my strategy is not to trade the market. My strategy is not to try to time the market and manage money for short-term performance. I'm just caring about absolute long-term returns. And I know that there's a lot of noise in the market, particularly now. You've got a lot of leverage out there. A lot of leverage. And that exaggerates the volatility in the market. It exaggerates it on the way up, and it exaggerates it a lot more on the way down. But it's the short-term thinking. I think the fact that I have the luxury of being able to think long-term. I think about everybody's account as if it were my money, and I'm not worried about being measured against a benchmark or being measured against somebody else. That's how the markets and the economy really got into so much trouble, because people just cared about the short run. They didn't care about the long-term consequences of their actions or their decisions. They cared about how it looked. in the short run. You know, there was an interview, 2 articles I read. One, they were interviewing a bank. I forget the name of the bank, but it had huge losses in their option arms. And the other one was they were interviewing, was either Fannie or Freddie. And they both of the CEOs they interviewed had basically the same rationale for what they did. You know, Fannie, the guy that headed up Fannie, said, well, you know, we had no choice. We had to lower our standards because everybody else was lowering their standards. And if we didn't lower our standards, then we were going to lose market share. And so we were forced to lower our standards to maintain that market share. Now, what kind of short-sighted thinking is that? You know, like everybody else is jumping off this cliff. Do you expect it to just stand there? You know, I mean, what they were looking at is, okay, here's my competitors that are making a bunch of loans that are going to go bad. So I want to do it too. I mean, if they were really thinking long term, they would think, you know what, this is great. My competitors are all going to go broke. Look how stupid they are. Right? My business is going to thrive in the long run because I'm not going to do the dumb things that they're doing. Now, sure, in the short run, I won't make as much money, but I'm going to avoid these horrific losses. And I'll be there to buy these guys out when they're all broke. But based on the way they were compensated, they're compensated with stock options and short-term performance. And the Wall Street analysts are rating these stocks. So what do they want? You got to beat the number. You can't tell me that your earnings are not good because you have higher lending standards than all your competitors, and so you're losing business. They didn't want to hear that. They wanted to cash out. They got Franklin Raines. Walked out of Fannie Mae. With $100 million. Where'd that compensation come from? It came from stock options. And the same thing with this other bank. They said, initially we resisted these types of low doc, no doc, teaser rate kind of mortgages. But they said, eventually the pressure was too great because we kept losing business to other banks, and then we lowered our lending standards, and business boomed. Sure, business is going to boom. If you're making loans, and you don't care if they ever pay you back, you can make a lot of loans. Right? You don't turn anybody down. Anybody wants a loan. And every time they approve a loan, they get a fee. And every time they get a fee, their earnings go up. And some Wall Street analyst puts a strong buy on their stock, and these guys cash out. But it's all short-term thinking. And the same reason that why do so many people buy all these subprime mortgages? Why do they do it? Well, because in the short run, the yields on the paper might have been 200 or 300 basis points above comparably rated paper. So, okay, this Treasury bond is rated AAA, and it's only paying 4%, but I can buy this mortgage-backed security paying 8%, and it's AAA. Well, 8's better than 4, and they buy it. And not only that, what the hedge funds would do is they say, you know what? If I can borrow at 4% and get 8%, why don't I just lever it up 10 times? And now I have not 4% but 40% profit. And of course I'm taking 20% of the profits, so I get rich. So there's a lot of leverage, but they're all thinking short term. Nobody thought, well, what's going to happen when these loans go bad? Well, who cares? Because I'm going to be rich before they go bad because it's my client's money. I make the money in the short run. As long as I can show short-term performance, I'm going to make money. It doesn't matter what happens in the long term. And people are still thinking that right now. What's happening right now in the markets? The markets start to move against. There's a lot of people in the hedge funds that are long the very types of stocks that we're long. Except they're doing it on leverage and we're not. They own oil stocks and mining stocks. And they own these foreign stocks that pay good dividends because it makes a lot of sense. But they don't just own them in a conservative way. They don't own them for cash. They own them with borrowed money.